Hi, Xavier, to Georgia. And we are now also live on YouTube and LinkedIn Live. And welcome to everybody joining us from there as well. If you have any questions for people joining us on YouTube Live and LinkedIn Live or YouTube, please use the chat button and enter your questions there, and we will transfer them to our panelists over here. Hi to India and to UK as well. Hi, everybody. We're just going to give everybody 1 more minute to join, and then we're going to start our webinar with Kaleido. Hi, Wai to Hong Kong. Good to have you here. All right. Thank you, everybody, for joining us live. We're just going to start with the webinar now. Hello, and again, welcome to everybody joining us to this webinar with Kaleido on streamlining delivery versus payment process with Hyperledger Technologies. My name is Tomasz, and I'm an ecosystem manager at the Hyperledger Foundation. It's great to see everybody here, including our panelists, which I will introduce in just a moment. But first, let's do some housekeeping. So first, I would like to emphasize that everybody is welcome in our Hyperledger community, and we are striving to create a safe and welcoming environment for everyone. So please follow our code of conduct when interacting with people on this webinar and also broader in the community as well. And you can find our code of conduct on our webpage and on our wiki as well. All of the Hyperledger Foundation member webinars are held under the LF Linux Foundation antitrust policy. These meetings involve industry competitors, so it's our intention to conduct all of its activities in accordance with applicable antitrust and competition laws. To see our antitrust policy, please visit our website and our wiki. This session is being recorded, and the recording will be later available along with the slides on our webinar library, which the link you can find here. So we encourage these webinars to be very active, and the more participation we have, the better experience for everybody, of course. So feel free to use the raise your hand button on the Zoom, and I will unmute you and invite you to ask your questions there to the speakers. You're also welcome to use the Q&A box as well as the chat to ask your questions. And for those of us joining us on YouTube and LinkedIn Live, you can use the chat button. All right. Without further ado, I would like to introduce our great panelists for today. It's Peter Broadhurst, who's a co-founder and head of engineering at Kaleido, and Andrew Richardson, who's a senior full-stack engineer at Kaleido. We're very much looking forward to this webinar. And Peter and Andrew, over to you.
Thank you so much, Tomasz, and great to hear everyone on the call and all the places that you're from today. So the session today, and we're going to be talking about digital assets and Web3 technologies, particularly in the context of a process called delivery versus payment. I'm going to do a little bit of a preamble here, keep it pretty short, and then we're going to hand over to Andrew, who's our engineering lead for this area of the platform in Kaleido, who's going to go into much more of the technical details, and there's going to be a real live demo in this session as well. So really hope you get some depth of understanding from us talking today. Because Kaleido might be new to some of you, I'm just going to give you a couple of minutes on who we are. So we've been around in the space since 2017, although some of the founders have been around in enterprise blockchain for a number of years before that. So we've really lived the journey of enterprise Web3 technologies from the earliest days here at Kaleido. And our focus has stayed the same throughout. It's not any one individual technology or token ecosystem, but rather taking this nascent potential of these Web3 technologies and digital assets and making them useful in the context of enterprise, making these things actually work and actually solve real-world business problems. We're lucky enough to work with a real spectrum of large enterprise customers. We do also have a very wide and open platform where anyone can even sign up for free and get started. So we see a lot of customers, but we also have the privilege of working with Fortune 500 companies across industries. We're going to be talking a lot today about particular areas of finance, which itself is very big, and we work across lots of different players in the finance space, whether that's central banks, networks connecting central banks, large payments companies, insurance, etc. We work across that space, but we also, as a technology provider, work across other industries, supply chain, ESG use cases, oil and gas. So we see really quite a broad spectrum of how these technologies can be used and what the similarities are. As a company, we provide technology. We are a technology partner. We are there to provide the tools that make these use cases possible. We're great friends with the Linux Foundation and with Hyperledger in particular. And we have Hyperledger open source at the core of a lot of what we do. Those who are familiar with Kaleido from our earliest days are probably most familiar with us in the sort of bottom layer of our technology stack, the Web3 infrastructure itself, running, hosting, managing, providing enterprise support and software delivery of chain infrastructure. Lots of different types of DLTs and blockchains, Hyperledger Besu, and the whole EVM ecosystem. And there's a huge spectrum there from providing connectivity to public chains like Layer 1 Ethereum or Polygon and other Layer 2s, to scaling technologies, the Arbitrums, etc. of the world, to really helping innovate in those spaces. What are the new models of public permission blockchains? How are they evolving? But not just the EVM ecosystem, where we do see a huge amount of innovation at the moment, but also other DLT technologies such as Hyperledger Fabric and other DLT technologies as well. So a real broad approach to the technology and what making this useful means to enterprise. And from the earliest beginnings, what you might have come across with Kaleido is that we've realized that the problem's bigger than any one sort of blockchain, bigger than any one DLT. And that actually making this technology useful to build applications needs a whole layer on top of that. So we're really excited that there's large open source projects at this layer as well. The middleware tier, the gateway tier, the piece that lets you connect to and across blockchains. And that's going to be a real focus of what Andrew's going to show you today, is how just connecting to one blockchain is not often enough in these scenarios. And building applications is actually about a lot more than the low-level connectivity to the chain itself. Key management, understanding and being event-driven, having an event bus that allows you to trigger the things that happen in your applications. So we use Hyperledger Firefly as the core of our open source middleware tier. We extend in and around that with enterprise extensions for key management, boundary security, deployment, etc., as you'd expect from an enterprise supplier of open source. We also have some layers on top that you'll see in action today around modeling digital assets, modeling the data across different places where your digital assets might be moving, bridging, automation, workflow, these sorts of capabilities you'll see in action today as well. And that does extend sort of a layer on top of that core Hyperledger-based middleware. So just stepping back then from who Kaleido is to the space as a whole and the evolution. The reason we're talking so much, I think 2024 is really the year of DVP. The reason we're talking so much about DVP and interoperability now is because it's where the whole space is up to. We started in the very early days where focuses were very narrow and siloed. We thought of Bitcoin in itself as a use case, digital gold. We thought of single chains being enough. Things like Ethereum just being one chain. We evolved in a second wave of innovation, particularly in a fully decentralized way, to finance things like stablecoins. Layer 2 started to evolve. The ability to move value started to evolve, and completely decentralized ecosystems with limited regulation sort of came into being, experimented, got some things right, got some things wrong. And we're really now in this very interesting third wave of evolution. And I know Steve talked about this in an earlier Hyperledger webinar some time back, where platforms are starting to evolve. I'm not just talking about technology platforms like Kaleido, but the kinds of platforms that our customers build on top of here. Platforms for digitizing assets, exchanging value, interoperating, and these platforms work across lots of ecosystems. So value is now no longer sort of locked inside of one chain, but actually Web3 is starting to evolve as this transaction model that can span lots of different blockchains, lots of different ecosystems, and work across and among them. And actually, some of the hardest problems, but the biggest value comes out of that. Transactions, real transactions, not micro little transactions as we think about on one individual blockchain, but business transactions. And there's three super big categories of these. Payment versus payment. Things like moving money across borders. Right, there's different domains where payments, where money exists. How do I exchange value between them? Delivery versus delivery, we'll talk a little bit less about this, but I've got something that exists and I want to exchange it for something else that exists. It might exist purely digitally. It might be a digital record of something that exists in the real world. It might be something physical like a diamond. Often it might be something like a bond or fractionalized piece of value in real estate, or all kinds of things that might exist in this sort of asset layer. And then the one we're going to focus on today, because it's the most complicated and the most exciting and interesting, is I've got something that's liquid, that's value like cash, or a token that's very fungible, and I want to exchange it for something of value. I want to pay for something, and how that works. This is really interesting because there's lots of different challenges that have existed for decades that are, well, actually, the challenges have existed for almost as long as money has existed, right? I've got something, I want to exchange it with you. I'm going to give you something and you're going to give me some value for it. Well, who goes first? Who's taking the risk? If I give you the money before I've received delivery of the thing, I'm taking risk. If you give me the thing before I've given you the money, you're taking risk. How do we manage that? We call that counterparty risk. What agreement are we going to have in place? How do we record the agreement of what we're going to transact? But actually transacting might be very complicated. Lots of things might need to happen. How do we settle that? How do we go from an agreement on a transaction to everybody owns everything at the end of it? And there's lots of complexities. If you read the extra bullet points here, in the real world, in real regulated industry, things of value, actually transferring them, managing the end-to-end, making sure it's safe to selling them, things like KYC and AML processes to be sure that it's a legal transaction, being sure that the transaction is actually complete at the end, being sure that the value that you receive can be spent onwards in the future, it's really worth something, making sure you really own the thing that you've been given. It's complicated, and we're not going to solve all of those problems today. But what we are going to do is to talk about the difference between the way things have worked for decades and the way things could work in the future, and how these new technologies of DLT and blockchain are going to change things. Because the way things have always historically worked are two parties enter into an agreement, a buyer and a seller. But because they don't want to, and they shouldn't, fully trust each other implicitly in all ways, they need to work out how to complete the transaction, protect their own interests, and be sure that the transaction is valid and complete. And usually the way that that's done is by trusting a third party, by both trusting an intermediary that exists, and actually you'll find intermediaries may or may not exist in the new world as well, and putting their trust in them, and that clearinghouse or other intermediary third party managing the complexity, performing the settlement, and managing the counterparty risk is the way the transaction happens. And these transactions often take multiple days to complete. They are complicated. The processes of this central party are complicated. And the new world of tokenization has the promise of making things faster, making them more efficient, creating new ways to trade, creating new business models that are more transparent, that happen more completely, because the sort of digital the digital programmability of these constructs, the digital programmability of the money, digital programmability of the asset are there to be efficient and to allow the process to happen mainly electronically, to happen much quicker if it should happen much quicker. There are reasons that are non-technical where you might want longer settlement times, but actually things can happen atomically. They can happen in a way where digitally the whole has happened or the whole hasn't happened. And that's actually quite a complex thing to do, even when you've got tokens involved. So as we drop sort of from this high level down into Andrew's section where we're going to talk about the technical details, you're going to see in practice some of the complexities and some of the tools that help solve that for these new tokenized forms of value and asset. So
I think I was muted. Can you hear me now?
Yes.
All right. Thank you, Peter, for the intro and for kind of setting the stage on what we're talking about. Let me share my screen and make sure that works. All right. Can everybody see my slideshow now? All right. So great kind of stage setting on, what we're looking at, delivery versus payment, exchanging one thing for another, paying for one thing, and managing all the sort of risks and challenges that go along with that. From here, I'm going to kind of dive down a little bit more into the technical layer. So it's definitely going to get a little bit more nitty gritty and a little more technical, but going to try to go through some of this quickly and then get to an actual demo that I think will tie it together. So maybe about another 15 minutes of sort of talking through, okay, what does this mean in a technical sense when I actually exchange different types of values using blockchain and using digital ledgers for some of that settlement? And how do I solve some of these challenges that Peter was talking about? I could easily spend a whole hour talking about this slide, so I'm going to try not to. I think the main takeaway here, just tying into the introduction, is that DVP is not one scenario. It's a whole system of different scenarios. Like Peter showed on the slide of kind of the evolution of the different waves of blockchain and crypto technology. We're sort of in this new wave where we're realizing that things are not confined to a single ledger. They're not confined to a single domain. There's not one way to do things. There are existing systems and new systems that all need to play together. And so there's really hundreds of thousands of use cases potentially of different ways you can put these pieces together and do different types of, I'm paying you for this item. That single kind of workflow can take so many different forms. It can be different depending on the different types of assets being exchanged. Are they currencies? Are they payments? Are they stocks, bonds, actual physical goods or commodities? Where do those assets live? Do they live in the same network, in different networks, or do they not live in digital networks at all? I think, we come to a Hyperledger webinar probably expecting to talk a lot about blockchain, and we certainly are, but I think Kaleido and the industry are all realizing that we're not going to have everything on digital networks. So it's a very real problem to solve where I need to tie these deliveries and payments happening on blockchain networks in digital ways with existing systems, whether those are existing digital systems like banking, real-time gross settlement, or physical systems like actual deliveries of paperwork, of goods. These all need to be part of the picture. It's not just a ledger problem, not just a blockchain problem. And then when I am talking between ledgers, what are the technologies I can use to move from one ledger to another? If they're the same protocol, if I'm talking two different Ethereum networks, if I'm talking between Ethereum and Fabric or some other combination, there are ways to solve all of that. But, depending on the use case, it's going to affect how you approach the problem and what tools you need to pull out of your toolbox. And then bridging is a whole separate topic in terms of, can I build a bridge that is trusted by the parties that are going between these networks? And what are the different technologies I can reach for to bridge between those ledgers? I think I'm going to kind of leave it there because some of these bits are going to be demonstrated in the next slides, and I don't want to talk too much at a high level, other than just kind of making the point that there are so many different variables that come into this. Kaleido, kind of as a company, our biggest philosophy around this is to look at each problem, to provide the tools that you need to solve these. And hopefully you'll see in the demo kind of one way that we approach that and how we put those tools together to solve every different flavor of DVP. So from there, I kind of want to walk through some of the common examples, right? I'm just going to go through 4 common combinations of all these hundreds of different bits that you can put together. Some that you may have seen if you've worked in this space, or that you may be able to kind of walk through if you're just kind of starting to think about these problems. The first one is single chain. And this is kind of the one that's been there since the earliest days of blockchain. And it's the one that I think a lot of institutions have in their head as this utopia when they come to thinking about how can blockchain solve my problems. And this is all my assets that I want to exchange are digital and they're in a single chain. I have some sort of digital currency, I have some sort of digital bond or equity or asset, and I want to exchange them between 2 parties in this ledger. You can do everything. If this is a programmable DLT like Ethereum, you could write a settlement contract that lays out these terms, if party 1 puts this in and if party 2 puts this in, these things change hands, the owners are switched, and it all happens or doesn't happen. And blockchain is really, really good at solving this problem. And you'll see, even as we evolve to other use cases, this kind of stays at the core as one of the things that blockchain technology helps us to do, right? This transaction always settles atomically, and the things both change hands or don't at all. And there's only one source of truth in this network. But oftentimes you find that this is not the case. It's not usually this simple in a lot of the real world use cases that are kind of facing us in this new wave of technology. So the first place you might step is, what if the assets aren't on the same chain? Everything's digital, everything's backed by ledgers. Maybe they're 2 different Ethereum chains, maybe a public chain and a private chain. Maybe they're 2 different chain technologies. But when you step one step away from that single chain use case, you already see a lot of differences come into this picture. The first obvious difference is that you do have to find some sort of connector. You have to have a way that both party 1 and party 2 can talk to both of these technologies. If the assets are over here and are digitized in one way, the payments are over here digitized in a different way, they need to be able to talk to both of those chains, and they need to be able to listen to both of those chains and hear things that are going on so that they can respond and kind of move both legs of this delivery versus payment along. The second thing is that even though we're dealing again with programmable DLTs in this picture, you need 2 of them. You need 1 on each chain. So you'll actually see some more of this in the demo that I'm going to do in a few minutes. So I won't get too in-depth on the technicalities here. I think it's easier to see it than to talk about it. But hash time lock contracts are one very common technology that work really well in this scenario, where my contract is actually 2 contracts that are deployed into 2 different places, and are linked together with some sort of agreements so that when I unlock one, I can unlock the other. The third thing that's different in this picture, and that's going to be a really important trend as we talk through the rest of these use cases, is that there is a point of no return or a point of locking that you can see I've indicated here with this asterisk. When you're doing things within a single domain, you can make them instant. In the first slide, that can be an instant transfer. And again, that's something that blockchain enables, that you can instantly exchange 2 things, and there's no point at which they are half done. Anytime you bridge to multiple domains, you can't do it instantly. You may hear some technologies or some people that say you can do it instantly. You can do it very quickly, but you can't do it instantly. And so there is some window where you have to lock something so you can do something else. And a big part of these more complicated scenarios is picking where that point is and how you enforce it. In the example here, I've pointed out one area that you could or would need to lock the transaction. And that's in this sense, if party 1 is committing a payment, party 2 is committing an asset. I'm saying here that party 2's asset would be locked in some sort of escrow to where they can't actually withdraw it until this trade is done or expires by some other means. While that's locked over here on the right-hand side, then they can withdraw their payment on the left-hand side. Then party 1 can withdraw the asset on the right-hand side. So having that window of locking, whether it's a short one or a long one, is going to be critical in a lot of these more complicated cases. Identifying where that is, identifying how you protect it so that there's no cheating. So you can't put your asset out and then take it back before the other person can actually take what's theirs as the terms of the settlement would lay out. Moving on, another very common scenario, and maybe one that is kind of uncommon to those of you that are thinking from a more sort of Web3 native perspective, is what if the thing on the right is not a DLT, right? These are very common use cases that we actually do run into a lot, and something that we need to be considering even when we're building part of the solution on a DLT. In this system, maybe there's a physical delivery, or maybe there's just a legacy system, some existing banking system, some Oracle database that records need to be moved in, and that needs to be coordinated with a transfer of value in a digital system that's running on Web3 technology. I've left the left-hand box kind of the same for this. The right-hand box can take a lot of different forms. I'm showing here a lot of times there's some amount of trust between these parties. Maybe party one and party two are two different banks that have an amount of trust for each other. Maybe they're members of an industry consortium in some particular industry. But they may have an existing legal framework completely outside of Web3, completely outside of blockchain for how they interact and transact with each other. In many cases, it's enough that my payment leg, maybe we'll say, is digitized, and I'm going to pay for some sort of transfer or asset using digital money on a blockchain, on a settlement contract. And then in the real world or in a legacy system, there's going to be this connector that's listening and says, hey, payment's been put in, it's gone to this point of no return, it's locked, you're guaranteed for some amount of time that this payment is available. Please transfer these goods or these assets or these records. And then that just happens through legacy systems, and they provide some proof that that's happened, whether that's documentation or whether that's an attestation or a signature. They provide proof that the delivery has happened. And then the payment can be released after you attest to some approval on that settlement contract. And if the delivery doesn't happen, you fall back to legal agreements, right? These companies often have ways completely independent of blockchain for sort of settling disputes and determining if one party didn't fulfill their obligations. It's not necessarily the most decentralized or the most Web3 solution, but I just wanted to include this picture to show that a big part of these DVP solutions is identifying your domains and identifying the rules of each one and separating them, because I think it's easy to muddle the rules and the things that DLT does solve in with the things that it doesn't solve. And it's perfectly fine for those to exist together, to have a ledger that provides programmable, immutable logic, and to have an existing system that works in a completely different way. And you have different rules in the two systems and a connector that joins them together. The last specific one I'm going to walk through before I kind of talk about a specific demo and show you a bit about how Kaleido approaches this problem as a toolkit for building these DLTs and connectors is, just taking it one step further. If that connected system, there's not trust, or there is extra regulation, which are maybe two ways of saying the same thing. But for whatever reason, in this picture, party one and party two are not going to deal directly. Peter pointed out in some of the introduction slides that this is how a lot of settlement works today, especially in the financial world, where you have an intermediary that's either going to actually physically hold things while the settlement is ongoing, or is going to stake their own liability that trade will happen. So in this, I've kind of put the point of no return on the right-hand side. You can see there's different points you could choose to place it, and it influences the order that this trade executes. Again, I've kept the left the same. You say party one is going to give some sort of digital payment. They're going to, record that commitment to pay on a settlement contract. And then by listening through a connector, the other party is going to then initiate a transfer through some existing means. They're going to transfer their assets to an intermediary who's going to hold them. Maybe an additional notary is going to be involved to sign off on that transaction and say, yes, the assets have been transferred. They're locked. They can't take them back. At this point, there's a time window that you have to settle this trade that can come back through as a notification into the blockchain system, where then the payment can execute. Once the payment is executed, because the blockchain gives you this guarantee that it's executed. There's no doubt. There's no in between. There's no gray area on the left. Either that payment has gone through or has not gone through. And then once it has gone through, the notary and the intermediary can be notified, and they facilitate the transfer of that asset back to party one. All right, so this is kind of that marrying of blockchain and sort of the way things currently work, and highlighting again that it doesn't all have to be on blockchain to realize the benefit. You still get enormous benefit from the left-hand side, being predictable, being immutable, being guaranteed, being atomic in that world. And there being no in-between where I may have been paid, I may not have been paid, I don't know if I'm going to get paid. That's all kind of streamlined on the left. And then I have some existing processes on the right. And one more point I think I want to make before moving on from these generic examples is that these just are generic examples. I've kept them somewhat pure in terms of where they fall on the spectrum. The thing on the left, it looks very much, well, I haven't labeled it specifically as such. It looks very much like a sort of typical crypto network, right? This might be an Ethereum network where party one and party two implicitly trust each other, probably because they can see all the balances, right? Maybe I'm using ERC20 tokens where everything's in the open and we know that the funds are there. We know that the funds are going to move. It's a very open ecosystem, the way I've drawn this picture. Doesn't have to be that case. There's plenty of ways to use Ethereum, to use different types of tokens, to mask balances, to use UTXO methods instead of standard account-based models. You can do all of this on any ledger, including Ethereum. And then that changes the picture on the left. Maybe I do need to involve other parties there. Maybe the parties don't trust each other, even though they're using a ledger. Maybe there's a notary involved over there that can attest, even though you can't see each other's balances, I attest that the balances are there and you trust me. Similarly, on the right-hand side, I've drawn this as sort of a traditional banking settlement flow that might involve a third-party settlement bank. But there's plenty of technologies in the Web3 space. If you're familiar with things like R3 Corda, there are a lot of similarities to this flow where there are a lot of sort of peer-to-peer messages that go back and forth. There are special parties in the system that sign off or hold things to say that, you know, I give my attestation that this trade will happen. And then the notary in that case actually publishes a list of transactions or a ledger, and the other parties replicate that ledger to have their source of truth for the world. You know, so you actually have a system that works a bit like this traditional system, but you also have elements of a ledger. So there's so many in-betweens and so many different forms that these can take, just kind of highlighting that I've shown 4 examples that are real examples that Kaleido has encountered that we've helped people build, but there's just innumerable variations on these on both sides. And it can get a lot more complicated, right? I've shown only 2 domains, 2 parties, but you can have many parties settling. It's not uncommon, especially when we're talking about these really exciting areas like central bank digital currencies, where you might have central bank money that lives on one chain. You might have Bank A has their commercial bank money on a different chain. Bank B has commercial bank money on a different chain. The asset that's being traded might be a government-backed asset that lives on another chain, right? You can have 2, 3, 4 different chains, legacy systems, all needing to integrate into one of these delivery versus payment flows. And you want them all to settle as atomically, as efficiently, and as reliably as possible. So this problem really does scale as you start to look at the real world. And just kind of, I guess, stepping back from the examples, the big problems with DVP, especially in this new wave that we're in, is with coordination. Things don't live on a single chain. They don't live in a single domain. So when I'm looking at a delivery versus payment problem, whether it's, you know, purchasing a bond or transferring different types of central bank and commercial currencies and doing exchanges between these things, it's about identifying how many domains do I have to settle. What are the rules within each domain? You know, which are domains that are ledger backed and can be backed by sort of programmable rules, which are domains that have sort of real world aspects, that have regulatory compliance, that have maybe third parties that need to sign off on them. And then how do I marry those? How do I build a connector? What technology do I pick that allows me to reliably listen to those things? And then how do I pick my point of no return at various steps in the flow so that I can lock one or more domains, safely execute and withdraw funds or assets in another domain, then unlock and kind of move forward. And this kind of sequence of events, planning it out, becomes a really interesting flow and puzzle for building a reliable delivery versus payment. I'll pause there. I'm ready to kind of walk into the demo. I don't know if Peter, Kevin was monitoring chat, or if there's anything else to add on sort of the ecosystem before I start showing rather than telling.
Nothing particular has come in on the chat. Just a note from me that in this session we're not going to talk about all of that variety in the ledger technology, you know, with or without EVM programmable base layer, like, because obviously a lot of these ledger technologies having a Byzantine fault tolerant ledger at the bottom of it is very optional. But there's even just like even if you went to EVM, there's huge variety in the privacy models, in the way that you approach it, the standards that you use. And we're really going to get into none of that today. So I just wanted to say that sort of like a pin in that for maybe future sessions, we'll have a chance to talk about some of that variety of technology.
Yeah, well, I know, I plug for Hyperledger in general. I know there are plenty of additional webinars going on targeting privacy, confidentiality, different things you can do with Ethereum and with different blockchain technologies. So yeah, not the topic today. And I've purposely tried to keep this sort of DLT box very generic because it's so easy to just talk about one of these things in itself for an hour. But yeah, lots of different things you can do within that DLT, and whether it's fault tolerant, whether it's decentralized, how decentralized, whether it's private, so many different kind of aspects there. Can a DLT smart contract through a connector directly link to an off-chain Oracle stored procedure for the on and off-chain solution? All right, pretty specific question. So I'll give it a quick answer and then maybe kind of come back for more towards the end. You can't necessarily, I guess direct linking is a sort of an open term for how you define it. What I'm showing here, it's going to depend, I guess, on your technology. Because what I'm showing here is that the linking usually takes some form of listening to things that happen over here, triggering things that happen over here, listening to things that happen over here, triggering things that happen over here. No matter how these different bridges and connectors are sort of pitched, that's usually at the root of it, how it actually works. So you definitely could, and tools like Kaleido would help you do this, build things where, a settlement begins on a blockchain and then listening to that triggers, something that calls across to your Oracle, triggers a stored procedure, waits for that to complete, triggers back into the blockchain. So I guess the high level answer is that it's definitely possible if you just write that sort of trigger logic. And I'm going to show a little bit of that in the demo maybe, and we might be able to come back and talk more specifically. Does that?
It does. I just wanted to say, I think the thing we probably won't cover today is actually directly that the biggest thing it actually means in DLT technologies is what identity is used and what attestation is used is actually the technical stuff's pretty easy. The identity is the most direct thing. And we're probably not going to cover identity management systems very much today. But I think you will see a lot of the technical stuff in the demo.
Yeah. I think it's probably good to move into the demo because we'll probably continue to get questions. And I do want to make sure we show some things. And then I'll definitely save some time at the end for more questions. So what I'm going to show today in the demo, I gave you kind of 4 examples of delivery versus payment and some ideas on how those work. I've picked one to show that I think is interesting and will be interesting to this audience. It's kind of aligned with the second scenario I described. It's multiple chains, but my assets are digital. Not getting too far into the linking off-chain systems because that's another whole area that can be interesting, but can be a very deep conversation in its own right. So what you'll see in my demo today, I have 2 Ethereum chains backed by Hyperledger Besu, a payment chain where I've deployed some ERC20 tokens, and an asset chain where I've deployed some ERC721s. I'm loosely using the ERC721 NFTs to represent shares in a bond and the ERC20 to represent cash. It's a very, very simplified example, probably not the way I would represent these assets in a production financial use case, but it's simple enough and illustrative enough that I think it can kind of show some of the coordination and how we approach this problem at Kaleido. So I have payment chain, I have asset chain. I have 2 banks that are coming to these chains that are each operating a set of Kaleido services. So they're each operating a node on each chain. So they have visibility to the payment chain, to the asset chain. They're each using Hyperledger Firefly as their middleware. So they each have 2 Firefly middlewares that sit on top of those 2 Besu nodes. And then they're using the Kaleido platform to kind of orchestrate all those events into a common place. We're using hash time lock contracts. So you'll see in my demo that the seller sets up a contract. They pick a secret, which they don't disclose. They take a hash of that secret. If you're not familiar, a hash would be a one-way encryption. So it's directly tied to the secret, but you could never recover the secret from the hash. So they're going to pick a secret. They're only going to share the hash of the secret. That hash is going to be used to set up contracts on both chains. So we're going to set up an asset contract where the seller is going to deposit their NFT that they're selling. There's also going to be a payment contract that's going to use the same hashed secret where it's expected the buyer will then deposit their cash payment. Once buyer sees these, the buyer is going to deposit tokens into the payment chain contract. And then the seller, at this point, when they see that everything's locked, this is the point of no return, the value is locked with a time lock. So I'll put a deadline on it where the NFT is locked over here, the payment is locked over here. The seller can then withdraw the payment. But in order to withdraw it, they have to provide the secret. The blockchain is going to use the secret, hash it, verify that the hash of the secret matches the hash that was used up front. That also has the side effect of disclosing the secret to everyone on the network so that the buyer can then use that same secret to unlock the asset. So the seller unlocks the payment, they disclose the secret, the buyer sees the secret, the buyer unlocks the asset, and then the things change hands on the two chains. All right. So that's what you're about to see. And I will just kind of start over here on the Kaleido platform, making sure I'm still logged in. Yeah, I get logged out. So this is the Kaleido platform. As was kind of mentioned in the intro, Kaleido's been around for a long time and actually has a couple of different products, including some basic infrastructure as a service that you can run even for free as a starter plan. This is our enterprise-grade asset platform, which includes not only infrastructure as a service, but a lot of hosted options for running these middleware pieces and these sort of aggregation and orchestration and bridging pieces in a cloud-hosted or a software deployment model. It's a microservice system, so you can kind of come in here, sort of an AWS menu style, and add different services to build out your particular application use case. So for this particular scenario, I've actually created all the services together in one environment. This would not be how a typical banking network would actually run. You would have Bank 1 managing their own instance, Bank 2 managing their own instance. These services would be deployed separately, but the blockchain nodes would be peered. For ease and just so I don't have to click around as much, I have created them all here just for this demo. At the bottom here, you can see I have my Bezu nodes that I was talking about. There's a payment chain and an asset chain. Each bank is operating a node on each chain. So, they have their node on the asset chain, they have their node on the payment chain. On top of that, I have these 4 services here, Firefly and Firefly Transaction Manager. These are both key parts of the Hyperledger Foundation, right? Hyperledger Firefly and sort of the side project Transaction Manager are both part of the open source community. This is Kaleido running enterprise versions of those, which are basically the open source code, plus additional plugins that make them even more robust and performant for enterprise loads. So I have each bank is operating 2 of them, like I showed in the sort of intro slide. Bank 1 has a Firefly and a Firefly Transaction Manager that are managing the payments chain and one that are on the assets chain. Bank 2 has one on the payments chain, one on the assets chain. Each of the banks has a key manager where they can manage their wallets. Many different types here in the platform of different wallets that can be integrated. I'm using HD wallets here. But as Peter mentioned, identity and wallets, a whole separate topic that I could talk an hour about. So I'm going to kind of gloss over it and not talk too much about identity and keys in this session. I guess a tease for potentially another session. And then on top of all of this, they have an asset manager, which is where I'm going to spend a lot of time today. And this is sort of, if you remember all the way back to one of the beginning slides, you may not, but Kaleido kind of looks at the system of blockchain nodes at the bottom, middleware tier, and then on top is these actual use cases like digital asset management. And so this is the service where you can kind of tell it what things you care about, tell it how you want to use those things, and it builds you a data model and a way of interacting with these items as assets, not as just, blockchain things, but, these are, in this case, bonds, right? Or whatever my asset is. This allows me to add that context and customize how I index these things. All right, so that's kind of the scene setting of what you see in Kaleido and what you can build. I'm going to kind of walk now through the different layers here. I think I'll start by just showing, for anyone that's not familiar with Firefly, this is not an in-depth call on Firefly. We've done many of those, so I'm not going to spend too much time. But one of the features of Firefly, and the one I'm probably using the most today, is that it actually takes your blockchain smart contracts and turns them into sort of APIs, more Web 2 friendly APIs. So I've got a couple of smart contracts that I already deployed to my chain. And I can see here's my ERC 721. These are all the methods on that contract. So Firefly here, I'm using as a gateway into my blockchain. The transaction manager below it is also going to handle, getting my transactions onto the chain in a really performant and efficient way. And you'll see how I interact with these different contracts. I'm actually not directly interacting with Firefly in this demo because the focus is on digital asset management, but it's a critical piece where it's, abstracting away the difficulties of the RPC method of interacting with the blockchain and turning them into APIs so I can then build interesting things on top of that. So from there, I think I'm going to spend most of the rest of my time up here at Asset Manager and just walk through one of these hash time locked DVP scenarios. The first thing I want to call attention to, I said Asset Manager is a way to sort of build up the things that you care about. And one of the ways we do that is through things that are called tasks and listeners. So in this network, I care about ERC20s that are happening on a payment chain and ERC 721s that are happening on an asset chain. So I've actually set up listeners. They're wired to Firefly. Firefly is going to be helping listen for these events. These are all the events of ERC 721. If you're familiar with how these NFTs function, these are all the events that they emit as things happen on that blockchain. Firefly is going to deliver me those events, and I've wired them to a task here in my platform. And this task is fairly simple. It's just going to kind of upsert different bits of data into my data model. So this is where I can kind of choose to install these different things. If I care about ERC 721, I install this indexing task that's going to listen for ERC 721 events and turn them into data model items here. So I can see here I have my bonds collection. This has been listening for a while as I've done a few of these DVP, and it's listening for things to be minted, and it's just indexing them. So we have here a very pluggable method for indexing any token standard or any asset on any network. With a bit of pluggable logic, you create these tasks, you index the things you care about. And then I've also created a few other tasks that are not for listening to things, but are actually for doing things. So the first thing I'm going to do is mint an NFT. This one is a single, just one-step task. It's just calling one of those REST API methods that Firefly exposed for me. It's calling safe mint, which is the ERC 721 method for creating a new NFT. But this allows me to just kind of take things that I care about and abstract them one level further and basically build my API. So here is the inputs that I've defined for this task. It's calling into that API. I'm going to mint it to myself as bank one. I'm not using metadata or URIs here, so I'm going to leave that blank. And these, again, all these services expose their own REST API. So these tasks kind of become your next level API for interacting with your assets. So as I did that, everything that happens here is going to kind of show up in an event stream. So here, this transfer was the mint of that new NFT. It created this NFT. It's going to be NFT index 3. I'm clicking through a lot of screens here because I don't really have time, I think, to kind of do a full tour of Asset Manager, but hopefully giving you sort of an idea of how we think about the shape of these problems. I have token index 3, and I'm just going to kind of move right along through here. The next thing I have to do is to actually approve that token to say that it can be used in a trade. This is the address of my hash time lock contract. If you know about these tokens, you know that when I transfer something into a contract, sometimes I have to kind of register a pre-approval so that contract can actually grab the token. And with that in place, I'm going to go here and I'm going to actually create the hash time lock contract. So token index 3, this is the address of my ERC 721. I'm going to put a time lock of 24 hours on here. Again, this is a task that's going to calculate some things. It's going to choose a random secret for me and calculate the hash that I'm going to use to sort of lock my trade. And then it's also going to insert an activity into my data model. It's going to kind of be, you'll see the aggregation point for this trade. So now that that's done, I have a new activity here. This is just another piece of the data model where I can kind of suck in things from multiple blockchains. And this is the really interesting bit where this platform provides orchestration and bridging for you. The only thing that's happened so far is that Bank One has offered an ERC 721 for trade. And Bank One knows about the pre-image, which is the secret, and the hash of the pre-image. If I flip over to bank 2, they're listening for these sort of events. Their indexing task has actually recorded this, but the pre-image was not sent in the open. They only know the hash of this trade. But they can create the corresponding leg for the payment. So I'm going to go here quickly. I'm going to approve a hash time lock contract to take 1,000 ERC20 tokens. And then I'm going to call another one. I'm actually going to go and grab I'm using this hash lock as the identifier. Like I said in the diagram, both of these contracts are going to share the hash lock so that they can both be unlocked with the same secret. Here, I'm going to create a new trade that's going to take in 1,000 tokens, that's going to share the hash lock with the other leg on the other chain. And you'll see that this, as part of this event, it's going to actually update this activity by my indexing task. It's going to update it. So now there's been an ERC 721 offered, this one. There's been a coin offered, a certain amount of coins. And now I'm in this point of no return. The assets are locked for that 24-hour amount of time that I kind of set. So the next step is back with bank 1. And I'm flipping between the chains right here. I've seen one thing happen on the asset chain, one thing happen on the payment chain. Bank 1 is now going to the payment chain now that they've seen. I think I'm going to need a second tab here. If they look at this trade, they see, oh, the payment has been locked in. I can go withdraw the payment now. So the payment itself has a unique identifier. And I'm going to trigger a withdrawal task here. I'm going to put in the contract identifier for that specific payment, which has been earmarked for just me to be able to withdraw. And here's the point where, as bank 1, I must share the pre-image. The way the contract is set up, you can only unlock it by sharing the pre-image, the secret, in the open. So I'm going to do that, and it'll actually trigger an event here. So I will withdraw. So I withdrew the payment on the payment chain, received the ERC20 tokens. I also disclosed the secret as part of that. So bank 2 here will have indexed and updated their activity. They have a task that's looking for that secret to come across. They now have the secret. And so they can do the same withdrawal on the assets chain and withdraw the asset that they were purchasing. So I'm going to run the withdrawal task. I'm running it through Firefly on the ERC 721 hash time lock. I have to put in that secret that I received, and I have to go to the original offer and get the ID for this offer, which again has been earmarked specifically to only be withdrawn by bank 2. I evaluate that, and then I'll have added another event. Takes a few seconds to get the block. And then that ERC 721 has changed hands. If I look at sort of the history of this NFT here, I can see the NFT was minted to bank 1. It was then deposited into this hash time lock contract. Then it was withdrawn by bank 2, right? So I've done this DVP, asset moved on one chain, payment moved on a different chain. Both buyer and seller were specifically protected by using this secret and by disclosing and locking things at the appropriate time so that value moved across the two chains. Using Kaleido and this asset management platform as my connector that both of them can use to talk to both sides. And then I have this whole stream of all the events, right? This is the raw set of events. And just kind of as sort of the tease for the other use cases I talked about and some of the questions, this stream of events is exposed in many different ways. You can connect a WebSocket, you can connect a webhook. So if you have systems completely outside of asset management that also need to be coordinated into this, you can listen to each one of these when a trade offer comes through, or when a transfer happens, or when a token's approved. You can listen to them all from outside the platform. You build with these tasks and indexers the stream of events you care about, then they're exposed out, and you can plug anything onto the end of that and kind of push things back in. So very quick kind of demo, just kind of hopefully showing at a high level how this sort of thing works and how you can orchestrate, really a fairly complicated multi-chain asset transaction and have just a really clear view of all the steps that are happening across both chains. I know we're getting close to time, so I'm going to pause there. Have about 6 minutes left to try and address any questions. Did you guys pull any while we were going on, Kevin or Tamaj?
Yeah, so I saw that Jim has already been answering some questions and Peter as well. And so I think what we had was already answered, and there's no questions that I could see on YouTube or LinkedIn Live. But now is the time for the people that are on. We have a couple of minutes left. If you'd like to get unmuted, let me know, or feel free to use the chat button.
There's been a bit of a theme to the questions so far, Tomas. So please break in if we get a specific question. But I think a lot of it is about when you've got the complexity of different ledger technologies, and you're connecting to them. Like there seems to be a lot of moving parts, right? And we're not covering everything today. But I wanted to point out, Andrew showed one variety where, as our party, like Bank One and Bank Two, chose to run infrastructure in both of those two different chains. They choose to run a node. The running of that node was their verification that that chain is working correctly, right? They're running the server or trusting a partner like Kaleido to run the server that is managing the clock of the machine that's going to verify with the consensus algorithm that time is being managed or whatever. There's lots of other different approaches to bridging, and one of the interesting things about these ecosystems, the domains, what are their model of trust? And you get into all kinds of different models of trust. Is it a tokenized economy? Is it a group of stewards of the network, a proof of authority based system? And the right hand side might have a different model of trust to the left hand side. And bridging a lot of the time comes down to how much trust you want to have as a party. Are you going to delegate some of your trust? Are you going to delegate it to a tokenized economy, or are you going to delegate it to a trusted party? And how far do you trust that party? So really interesting set of questions, I think. Did that give any time for questions to come in, Tomas, as I waffled there for a minute?
Yeah, thanks for wrapping it up, Peter. No, we didn't have any new questions, but it's great that you also shared that, the last slide. I always encourage people to reach out to you as well, because there's going to be a lot of people watching this later on YouTube and so on. So I think it's great, and we'll be sharing these slides in our webinar library as well.
Yeah, I mean, I think the sort of theme here is, you saw in some of the early slides that we've had different waves of crypto, and they're kind of getting bigger. There's more use cases and bigger use cases. It's really tough to tackle something like delivery versus payment in a single hour, because there's so many different forms of it, and there's so many different interesting aspects you can go into. And they're exciting problems, and they're very solvable problems, and we love to kind of dive into the specifics of each of those layers, whether it's how my ledgers work, how I handle privacy, how I handle identity, how I handle bridging, how I handle interop. They're all, there's just different options that you choose depending on sort of the thing you're building. So yeah, very, very happy to have, reach out to us on our website, reach out to us on Discord, and we love to continue that conversation.
That's great. Thank you so much. We only have a minute or two left, so unfortunately we have to wrap up. But for those of you that your questions didn't get answered, feel free to reach out to Kaleido. You will have the contacts here, or reach out to us at Hyperledger, and we will connect you with Kaleido as well. So thank you very much to Andrew and Peter for this great content that you shared. And thank you everybody for joining us on this Hyperledger in-depth webinar. Now, before we go, I would like to invite you also to follow our event page. We have some new webinars coming up, and we also now announce our live events here, so you can join us in person, such as Consensus in Austin, Texas at the end of May. Visit also our meetup page, where we announce our upcoming meetups and workshops, which you are always welcome to attend. We do a lot of, throughout our community, we do a lot of thought leadership pieces. So we have a CBDC ebook, we have supply chain and trade finance ebook, and these ebooks are also translated into different languages. So feel free to share them within your network to get this knowledge. I would also like to invite you to join our Discord channel. So we have access for all of our projects, for Fabric, for Besu, for the channels for our special interest groups, for our working groups, and so on. There's a lot of real-time interaction going on there, and you're welcome to join. And for the corporate membership, if you would like to become a Hyperledger member, feel free to ask your queries to membership@hyperledger.org. Thanks everyone for joining us, and thank you again, Andrew and Peter, for this great content, and for everybody to listen to it. And as well, thank you for those joining us on LinkedIn Live and YouTube. And until next time.
Thanks.
Thank you.